Hello, and welcome to the S&P Global Platts Future Energy Podcast, where today we will be talking about the release of our Future Energy Outlooks guidebook, laying out our long-term views on the development of the global energy sector. Let me introduce myself. I'm Roman Kromarchuk. I head up Future Energy Outlooks at S&P Global Platts, and I'm joined today by Dan Klein, who heads up Future Energy Pathways. You'll have an insight into how we interact because we work closely together to put together these outlooks and forecasts. And you will have that from a side share as we discuss some of the key topics. I think we'll start off with where we were last year and where we are this year, because when we released our outlook and our guidebook last year, it happened to be in February, right before the full implications of the COVID lockdown were hitting us. So that wasn't the best of timing because, as we all know, a lot of things changed with COVID. But some of the key questions are how much changed, how much is going to come back to the way we knew before, and from the perspective of energy transition, what does COVID really mean for the energy transition? Will things speed up, depending on how you define that? Will the transformation and the decarbonization be different? So I'll leave the floor to you to kind of walk us through what we came up with.
Yeah, thanks, Roman. And you're exactly right. When we put out our annual guidebook last year, the world was going through some pretty major changes, and we didn't really know how things were going to develop at that point. In mid-February, when the guidebook was put out, we were thinking the possible downside to oil demand might be a loss of 1 million or 2 million barrels a day, which was relatively small compared to the magnitude of what losses we came out. So over the past year, which ultimately developed into what came into this year's guidebook, we developed the three main areas where things have changed because of COVID-19 and the long-term outlook. And number one, and the biggest, is the change in the macroeconomic environment. Clearly, we've lost a lot of demand in the short term, and there is going to be a pretty strong recovery in 2021 and even into 22 and a few years after that. But the magnitude of the loss that we've observed already in 2020 and still some of the headwinds that we're facing is not going to get the global economy back on track to where we had thought it would be about a year ago. In that vein, because of the close relationship between the global economy and energy demand, we've lost a lot of energy demand compared to our forecast from last year. The second major area is a potential change in behaviors, and this is something that is clearly on observation in everyday life. People are traveling less, they're flying less, and there are some major implications and question marks about if this is going to continue and to what extent. And we certainly think that it's a bit in the middle, that we're not going to go back to life as it was pre-COVID-19, but it's not going to be everyone is going to be working home forever. And finally, the third thing is what policies that are going to be coming out of play because of COVID-19. There's certainly a lot of policymakers that are using this as a way to bring forward some of their longer term carbon goals or energy efficiency goals, while other policymakers might just see this as a need to stimulate their economy and forget about what the implications for clean energy might be. So overall, we've reduced the outlook for demand and emissions because of COVID-19, but it isn't exactly kinking that curve away from what we had for growing and plateauing emissions in the mid-decade and not tilting us down to what we would need to see in a 2-degree scenario or a net zero scenario for the globe.
So Dan, moving from that, I mean, do you think that, yes, we've seen record levels of carbon emission reductions in 2020. We do expect a rebound in 2021, but we are still clearly not getting to the level of reductions that we would need to meet a 2-degree scenario. Is that a fair assessment?
Absolutely. There is pent-up demand and a recovery that is going to happen in the global economy. People are going to get back into cars. They're going to want to travel and see things that they didn't get to do in 2020. And the amount of what's already installed, whether that be the car fleet, power plants, industrial facilities, is not really going to be changing all that quickly. So we are in that environment. That being said, there is greater focus on the energy transition, a greater desire. And so there is a deviation from what our view was last year on carbon emissions. But it is more of just a step down of parallel lines, not really kinking that curve to say down towards a 2-degree scenario.
And we definitely have seen some differences, for example, in terms of how Europe is using the opportunity to create a stimulus package to really drive the clean transition. Whereas, at least in the short term, what we've been seeing in China has been one that's more focused on jobs, more focused on bringing up the economy, which actually has been bringing up energy use, which may not have been that green in the short term. So, what we've been talking about so far is really reasons why COVID has really changed behaviors and brought emissions down. Are there any other, is there a flip side to this? Can we consider that COVID actually means that an energy transition may happen slower?
Absolutely. And a few key examples here is maybe even on the behavior side, there might be some changes here where people who may have taken public transportation in the past after going through this COVID time might not want to go back to public transportation and feel more secure driving a personal vehicle. But ultimately, in the adjustments that we made from last year to this year because of the loss of demand globally, we caused us to reduce our pricing outlook for a lot of the fossil fuels, oil and gas specifically. And as markets work, a lower price will mean higher demand, especially in areas that don't have policies to keep this sort of demand rebound underway. And thinking about how new technologies might come into play here. And the best example of this is electric vehicle. When you think about the usage of an electric vehicle and the decision to buy one and operate one is going to be on the economics of how this operates. And if long-term oil and gasoline prices are lower than what they were expected to before, the electric vehicle penetration rate is going to be slower than what you had had before. And that's certainly one of the adjustments that we made over the past year. So not all things from COVID are directionally in the same way. There are always feedbacks, and that's one of the key services that we put into the guidebook here to show of how does the market react and iterate around itself.
We're talking about electric vehicles and their role. And, you mentioned the fact that we do have total cost of ownership models that reflect these decisions. Maybe I'll use that to transition to another topic that is related. There's always been a lot of discussion about peak oil. When is that date? And, it's never going to be it's hard to forecast that date, but we're looking at the general time frame when it looks like total oil demand and maybe subsets of oil demand will be hitting their all-time highs, after which they'll start declining. So can you share some of your thoughts in terms of what we've been showing in the guidebook, what our latest research shows around what's happened to that period of peak or plateau?
Yeah, I think it very much parallels what I was talking about earlier about a step down in demand from our expectation last year, but not a transformation of that outlook. So what I mean by that is, of course, we've lost a lot of demand and oil demand in 2020, and the recovery in 2021 will not get us back to where we were in 2019. But a lot of the same driving factors that we saw for oil demand going forward are still intact. Its relationship to the global economy, the growing middle class, the demands for transportation that are all related with that. And so there are sectors that will continue to grow and drive that factor. And some of those that you may not think too much about, where the heavy commercial transport or marine bunkering are still going to grow over the longer term. The passenger vehicle sector is an area that will ultimately soon peak and plateau, and that will have some major implications. But behind the scenes here, petrochemical sector is one of the main factors that, in our view, is going to support continued global demand growth until the 2030s. And I think the focus on what peak demand is and predicting a year in which the demand is going to peak is a little bit misplaced. Mostly because we don't see demand rising strongly and then all of a sudden reversing course. We see this as being more of a gentle change where there's going to be more of a plateau, which is frankly probably going to start in the next 10 to 15 years and have ups and downs depending on what happens to the economy and weather and other factors. So there's going to be an extended period of very flat oil demand, and you could have ups and downs in that period. But we believe that to be the ultimate peak in demand will be probably in the second half of the 2030s. And that is still in line with what we had for last year, but it is at a much lower level from what we had last year, on the order of 4 to 5 million barrels a day lower than our expectations last year.
So, for the people that like to focus on the timing of the peak, our message is one that, well, the timing of the peak hasn't really changed all that much. Definitely the total level of that peak is going to be lower, which means that the associated emissions and the associated need for new resources is going to be lower as well. These are some very interesting key factors to keep in mind. And the dichotomy that you pointed out, the fact that we see petchem demand actually providing a big source of the structural strength. That is a key point. And, I think we even saw that in this COVID period, where definitely when we're talking about jet kerosene, we see substantial losses. But when we talk about the use of plastics, maybe Dan, you can talk about that a little bit as well, because I thought that was an interesting take.
Yeah, absolutely. And it's interesting that when you look at the subsectors of oil demand, the petrochemical sector still grew in 2020, despite everything that happened during that year. And if you take a closer look at even within that sector of petrochemicals, there was a downturn in the use and the creation of certain types of plastics, the more durable plastics that you would see in construction or more industrial activities. But there was a commensurate sort of support for that in the lighter grade plastics, things that you think about every day about plastics, the single-use plastics that can be even used in the medical equipment or the personal protective equipment that was so vital during this COVID period. And that is sort of illustrative of the sector as a whole, that no matter what happens in the cycle, there is going to be support for whether that be more from the industrial sector and more of those heavy grade plastics, the polypropylene, and that certainly is going to be a key factor in this rebound as the economy gets back on its feet, or this growth in the lighter duty consumer driven products that are going to be going forward. So the petchem sector was still up, and it's going to accelerate growth in 2021 as the global economy gets back on forward. And this is something that is going to continue and drive overall oil demand for the next 5, 10, 15 years.
So I'm going to change tacks and kind of to reflect also what we have in our guidebook, because I'm going to talk about not just our existing suite of hydrocarbons and energy sources, but also talk about the mosaic of solutions. And when we're talking about solutions, the mosaic of clean energy solutions to move towards a more decarbonized world. Something that we've been spending a lot of time on over the past 2 years, as Platts Analytics, is hydrogen. And to be sure, hydrogen, we devoted a separate chapter specifically looking at the potential for hydrogen uptake and thinking about how it flows through both on the production and on the consumption side in a key country like Germany. That is one of the chapters that we've added to our guidebook this year. We're going to be expanding that coverage, and that's something that's going to be integrated into our overall modeling framework more so than it is now and more accessibly than it is now. But I want to kind of touch upon some of the thoughts, because when we think about something that is right now rather expensive, and it's a technology, particularly on the electrolyzer side, where the electrolyzers are still expensive. Maybe if you can talk through some of the challenges that you thought through, that I know we've had discussions about, in understanding and to putting a better finger on the pulse of what we think hydrogen uptake is going to be like, and what are some of the factors that we consider.
I think when you're talking about challenges, I think it's first interesting to talk about the opportunities and the promise, because for many years, hydrogen was seen as a great solution for a lot of sectors that are difficult to decarbonize, but it seemed to be far off in the future. But what's really been one of the most surprising things over the past, say, 3 years is how much that development has accelerated. And for good reason, because of the potential usage of hydrogen in a variety of sectors that things like electricity just aren't suitable for. Heavier applications for transportation, decarbonizing things in the industrial sector that electricity isn't good for. So clearly there's a lot of opportunities, and that's one of the reasons that everyone is excited about. But the challenge is, as you mentioned, number one being the cost, is it's a very expensive technology and process to create hydrogen in a low or zero carbon way. And that is something that is clearly going to be driven by policy. And there are areas around the world that high cost can be overcome and will be overcome because of policy drivers. And Europe is certainly that area where it will overcome that barrier by that support. And ultimately, consumers, governments, taxpayers are going to have to foot the bill for hydrogen or other of these clean energy technologies. And on top of that, there are some logistical issues on top of just the production costs that oftentimes get overlooked. The transportation of hydrogen from the point of production to the point of consumption can be very prohibitive, and the efficiency losses of converting one form of energy to another can be very high.
And Dan, I think I would echo your statements, but I will also echo your statements about the policy drivers. It's not a coincidence that we chose Germany as our case point, because first of all, you mentioned that Europe and the European Commission's strategy on hydrogen has set some pretty aggressive targets on what they'd like to see in terms of both electrolyzers and in terms of hydrogen production. Clearly, there's an appetite and a desire to be leaders in that space. And as we know, when we look at other sectors, when we look at, let's say, batteries and electric vehicles, or when we look at solar PV, there's nothing like uptake and scale to start driving down costs. And that's part of what I think is part of the European strategy to start moving those costs down to make hydrogen as a solution much more affordable. And when we're talking about solutions, we start with solutions in terms of dropping in, replacing conventional hydrogen in refineries and ammonia processes, but also, injecting into pipelines, using it in steel production, using it for heavy duty transport, using it even in marine fuel applications. So something we are clearly looking at. This is a space to watch for sure. Now, the interesting thing, I'll kind of move from hydrogen, but not move perhaps that far from hydrogen, because when we talk about how hydrogen can be made, two primary processes. There's obviously others using coal and other feedstocks, but the primary ones that we think about are electrolysis, where electricity is used to create the hydrogen, and the other is using natural gas through a steam methane reforming to create hydrogen that way. But this brings us back to the issue of natural gas, because there a lot of the conversations, when people think about the opportunities to decarbonize, coal to gas switching is a big one. But the question is, when you need to move to net zero, or even when you need to move to 1.5 degrees or below, then the question is natural gas really a bridge fuel? And that's something that I know we looked at as well.
Yeah, absolutely. And I think the first thing to think about what the role of natural gas is, and this relates to one of our earlier points here of how much total energy demand has been lost compared to our outlook, is that gas's proposition for the long term was to meet incremental energy demand load and to offset losses or the retirement of coal and to a lesser extent oil. So it did sort of bridge that gap between where we were and where we are in terms of demand growth, as well as some of those sources that are going to be winnowing away. But if you think about how much demand has been lost, so that bridge that the gas needs to span has gotten narrower compared to our previous outlook. And you're quite right to note that gas is still, in most of its forms, a carbon-emitting source. And if you need to get to essentially zero emissions, you can't continue to use gas in the way that it currently is. So you either need to have carbon capture and sequestration, or to use it in ways where you're not combusting those molecules. So it is a challenge to do that. And I think ultimately, when you think about where gas is going, where the market is scrutinizing gas, and looking at emissions not just at the point of combustion, but upstream and methane slippage, there are some major challenges for gases continuing to grow. And I don't want to say that this is very negative across the board. Gas is still going to grow across our entire forecast horizon, but it is going to be more limited in its applications, especially if you think about more and more countries joining the net zero club. There's going to be more fears about whatever you invest on gas infrastructure could become a stranded asset if you ultimately can't use them over the long term. So there are major questions about gas, and this is a topic that you know very well that we've been pointing out for several years, that there have been more questions about gas demand growth than supply growth, because it seems like gas has become so abundant that it is more searching for demand rather than the other way around.
No, and that's a key point. I think, when we sort of think about and try to put in our minds an image of this bridge, on the one side, there's the renewables and all the growth that's coming in. And, we expect this renewable growth to continue extremely strong. And on the other side, you have this sort of stickiness of coal on one side, which, in Europe and the US, we're seeing retirements, but the question is, will you still see that same level of retirements if you're talking about, let's say, a Chinese coal plant or an Indian coal plant that was just built a year or two ago? That's one part of the stickiness that we expect gas to face some challenges against. And the other piece is really kind of nuclear in places like the United States, where as long as those older nuclear plants stick around, they are able to provide a sort of baseload level of zero emitting generation. So this is a key topic that, we will continue to discuss because it's one of a key issue for our balances. We've gone through a few of these key themes. The fact is that, Dan and I and our team has put together a guidebook that goes through many of these themes and many more themes. It's, for any of us, we joke around who's going to read that 300 pages and go through all the data and charts. Well, very few of us, but if you want to go through and find specific topics on technology, on policy, on any particular outlook for any particular commodity, this guidebook would be the opportunity to do so. At this point, I want to thank you for taking the time and thank our listeners for tuning in. For more topics on energy transition, I encourage you to please check out Platts Live. at platslive.com, because a lot of what we're talking about now will be available there. And if you're up for reading a 300-page guidebook and following all the additional research that we are doing in this space, feel free to reach out to us. Thank you very much and have a good day.